Welcome to the Apprentice Trading Library. In this segment, we will provide you with insights into the fundamental analysis basics: earnings, PE ratio, and revenue. When it comes to evaluating a company's worth, the numbers tell the story. Fundamental analysis is your guide to understanding a business's health and long-term potential. Today, we'll break down three key fundamentals: earnings, the PE ratio, and revenue. Let's dive in. What is fundamental analysis? Fundamental analysis involves examining a company's financials, industry position, and economic conditions to assess its intrinsic value. It's like reading a company's report card to determine whether it's worth investing in. Let's talk about earnings. Earnings are the profit a company makes after covering all expenses. They are the foundation of a company's financial health. Earnings per share, EPS, this metric divides net earnings by the number of outstanding shares, giving you an idea of profitability per share. Why does it matter? Because consistently growing earnings suggest a company is performing well and creating value for shareholders. Let's go over the price to earnings, otherwise known as PE ratio, compares a company's stock price to its earnings per share. It's a way to gauge whether a stock is overvalued or undervalued. The formula is stock price, earnings per share. What does it tell you? A high PE might indicate growth potential or an overvalued stock. A low PE might suggest value or a company facing challenges. Use the PE ratio to compare companies within the same industry, as benchmarks can vary across sectors. Revenue, also known as the top line, is the total amount a company earns from its operations before expenses. Why is it so important? Because strong revenue growth indicates demand for a company's products or services. Flat or declining revenue could be a red flag. Pair revenue with other metrics, like earnings and expenses, to get the full picture of financial health. By combining these metrics, you can make more informed investment decisions. For example, a company with rising earnings, a reasonable PE ratio, and growing revenue is often a strong candidate for investment. On the other hand, red flags like high PE ratios without earnings growth or declining revenue may signal caution. Earnings, the PE ratio, and revenue are just the start of fundamental analysis. By mastering these basics, you'll build a strong foundation for evaluating any company. Thank you for watching the Apprentice Trading Library. Visit verifiedinvesting.com for expert insights and tools to empower your financial journey.